The global financial system is sitting on a ticking time bomb. But this isn't just any bomb. It's a $1.2 quadrillion derivatives market quietly threatening the entire global economy. Most people have never even heard of it. And that's exactly how the institutions want it. Derivatives are complex financial contracts tied to the value of other assets, like bets on interest rates, commodities, currencies, or even weather. In theory, they're tools for managing risk. In reality, they've mutated into the most opaque and dangerous instruments in modern finance. To put this into perspective, the world's total GDP sits at around $100 trillion. The global derivatives market? Estimates put it at over $1,200 trillion, 12 times larger than all the goods and services produced worldwide in a year. And here's the kicker. Most of these contracts are unregulated, hidden from public view, and concentrated in the hands of a few megabanks. So why does this matter now? Because the cracks in the system are no longer hypothetical, they're forming in real time. Major financial institutions like JP Morgan, Citigroup, Deutsche Bank, and Goldman Sachs are swimming in derivative exposure. And the moment interest rates began rising aggressively to combat inflation, those contracts began to wobble. That's where the real danger begins. See, many of these derivative deals are time-sensitive. They rely on short-term liquidity and favorable conditions. When rates spike or collateral requirements increase, the math behind these trades stops working. Suddenly, what was once a manageable bet becomes a high-stakes liability. And the ripple effects? Catastrophic. A single major counterparty defaulting on a derivative contract could trigger a margin call chain reaction. This isn't theoretical. It's how Lehman Brothers collapsed. Only this time, the size of the market is exponentially larger, and the Federal Reserve is no longer in the same position to bail out the system. Back in 2008, the U.S. national debt was around $10 trillion. Today, it's over $36 trillion, with over $1 trillion being added every 100 days. The government is already paying nearly $1 trillion a year in interest alone. That's unsustainable. It means there's far less room to maneuver if another crisis erupts. The Fed is trapped. Raise rates, and you risk detonating leveraged derivative positions across the financial sector. Cut rates, and inflation returns, undermining trust in the dollar itself. Either path accelerates instability. But there's another layer to this problem, one the public rarely hears about. Much of derivatives exposure isn't even recorded on balance sheets. It's hidden, relegated to what's called Level 3 assets, financial instruments whose value is based on unobservable inputs. In plain English, no one truly knows what they're worth until the house of cards comes down. That's why even central banks are warning of hidden dangers. The Bank for International Settlements recently published a paper sounding the alarm on non-bank financial institutions holding vast derivative risks, institutions like hedge funds, pension funds, and insurance companies. These entities don't face the same scrutiny as regulated banks, and their exposure is often magnitudes higher than reported. This isn't just an economic story. The political one. Because when this bomb goes off, governments will scramble to maintain control. That means emergency powers, capital controls, forced conversions of assets, and potentially a rapid rollout of central bank digital currencies to replace collapsing fiat systems. And don't think it's just a possibility. The infrastructure is already being tested. The IMF has openly discussed global digital currency platforms. The World Bank and BIS are working on cross-border blockchain settlements. And in the U.S., the Federal Reserve has quietly developed FedNow, a real-time payment rail that lays the foundation for programmable digital dollars. This isn't about fixing the old system. It's about replacing it. And that raises a haunting question. Is the 1.2 quadrillion derivatives bubble being allowed to grow unchecked? Not out of ignorance, but by design. Is it the trigger they're waiting for? Because what better justification for a great reset than a global financial detonation no one saw coming? And behind the scenes, massive asset managers and banks are positioning accordingly. BlackRock is pouring billions into digital asset infrastructure. Fidelity is expanding crypto custody services for institutions. Ripple, with its XRP-powered settlement technology, has signed over 1,700 non-disclosure agreements with banks and financial entities preparing for a digital transition. Let that sink in. These aren't crypto startups or retail investors. These are the architects of the current system, quietly pivoting toward the next one. They're not fighting blockchain, they're building with it. The real story is not just about a potential collapse. It's about controlled demolition to make room for something new. And while the media keeps the public distracted with elections, celebrity trials, and temporary relief programs, the financial elite are laying down the rails of a new system where every transaction is trackable, programmable, and permissioned. Once the derivatives bomb explodes, there will be no time left to reposition. The velocity of collapse will be breathtaking. Markets will freeze, credit will vanish, and trust, the foundation of all money, will shatter. What happens next depends entirely on how prepared you are. Because when that moment comes, the world will divide into two groups: those who saw it coming and positioned themselves early, and those who are left behind, waiting in frozen bank queues, staring at empty ATMs, wondering how it all happened so fast. But you won't hear about this on CNBC. You won't get a warning bell from the mainstream. This crisis, when it arrives, will be silent until it isn't. The only clue you'll get is the sudden silence from the institutions who once told you everything was fine. What's even more concerning is how interconnected these derivatives are with everyday financial instruments: pensions, mortgages, insurance policies, and even municipal bonds. A single major disruption in this web could ripple across the entire economy, freezing liquidity and forcing massive asset revaluations overnight. The problem isn't just scale, it's complexity. With trillions of dollars in derivatives tied to interest rates, currency swaps, and credit default swaps, any sharp move in global policy or unexpected geopolitical event can detonate the weakest links in the system. Recent warnings from seasoned market analysts suggest that the vast majority of these derivatives are not fully collateralized. That means in the event of a crisis, the losses won't just sit on a balance sheet, they'll spill into the broader economy. And with central banks already at or near the limits of their intervention capabilities, there may be no safety net this time. In the early 2000s, Warren Buffett famously referred to derivatives as financial weapons of mass destruction. 2 decades later, they've only grown more intricate and more dangerous. Banks and hedge funds continue to write these contracts at scale because they've become addicted to the short-term profit they generate. But long-term stability? That's been kicked down the road again and again. If you've made it this far, consider subscribing to Wealth Signal. We go deep beneath the surface and uncover what the headlines won't say. If you want to stay 10 steps ahead of the coming financial reset, not just survive it, but thrive through it, then subscribe now. Your future self might thank you. This debt-based system isn't just inefficient, it's dangerous by design. The entire economy depends on confidence, but confidence alone can't pay off a 1.2 quadrillion derivatives exposure. The complexity of these contracts means that a shock to just one part of the system can ripple across global markets in minutes. That's what happened in 2008, but this time the stakes are even higher. Institutions like Deutsche Bank and JP Morgan are so deeply embedded in these contracts that even a minor default could trigger cascading margin calls, systemic liquidation, and frozen credit markets. This isn't just a theoretical risk. It's a mathematical certainty if nothing changes, which is exactly why newer technologies like blockchain-based settlement and decentralized finance are being fast-tracked behind the scenes. Because the current system isn't just outdated, it's a live wire waiting to snap.